Hey, and welcome to TSOB. This is a podcast for entrepreneurs who are interested in investing or starting their own funds. We are Adam Anderson and Zach Eikenberry. Join us to get a behind-the-scenes look at the relationships between founding entrepreneurs and the VCs that invest in them. So, Zach, you're traveling. It was your wedding anniversary yesterday. How long have you been married?
8 years.
So we'll talk about marriage and entrepreneurship one day, but not today.
Yeah. Let's talk about the easier things, starting businesses and raising money.
There you go. Yeah. That's fantastic. So we're going to have a little bit of grace for Zach today because he is off tracing around the world, doing all kinds of cool stuff. Can you show us the space rock?
Yes, it is. Right there.
And what's that story?
Well, so the gentleman who started this coffee shop in Florida, Indiana, you can look it up. Population is a little under 2,000 people for the whole township. He is a Purdue grad, like myself. And I don't know if you know this about Purdue, but it's the cradle of astronauts. Something like 28 of the 34 people who walked on the moon are Purdue grads.
No kidding.
And yeah, he did not walk on the moon. He did the high space orbits in the space station. But he is a fighter pilot trained through the Navy and became enrolled in the program that ended up being an astronaut program. It's not called that. And long story short, he came back to Florida, Indiana, and started a coffee shop based upon all things cosmos.
And what's the name of the coffee shop?
I cannot tell you how you meet Cosmic Coffee in Florida, Indiana. I cannot tell you what a juxtaposition oddity it is to have a Cosmic Coffee shop in Florida, Indiana. I don't know how to describe that to people, how awesomely odd it is.
Well, we should get a coffee one day, especially when we do the recording of our, a couple weeks from now, maybe a couple months from now, when we start talking about the space sector for investment. But right now, we're going to be focused on what we're focused on, and that is the project you're currently working on, the company you're currently building, and the fund that I am currently building to support all the fun things that we are doing. So I thought we would start and try to get a little bit more formal in our approach on this. One of the things that we typically do is we have a big question that I want to discuss. But I thought, why don't you tell me what the big question that you're working on, like tactically, in your journey as a CEO that's raising money. And then I'll tell you the big question I'm working on. And then we'll see where we go. So you go first. What's the thing today? What is it? July 20th, 2022, the time of this recording, that is on Zach's brain. What's the big thing? You're like, I got to figure this thing out.
Yeah. So I'm going to frame it like this. The big thing that I cannot bake into all of my decision-making process is how many folks in our world are telling me the sky is falling and that I should raise capital because we are headed towards a crypto winter, a capital access winter, and a recession that could last 18 months to 2 years before things are corrected. And so I do not know how to bake that in to all of the fundraising, the planning, the scenario work that I'm doing with our team as we continue to fulfill plans that we made in Q2 and Q1, hiring plans, fundraising plans, etc. All those wheels were in motion, and we're doing those now. We declare victory on our bridge. We raise more than we intended to raise. We have money in the bank. We just hired 4 people this month alone, starting, which is 25% increase. And I have these little voices on my shoulder telling me, keep growing, do this, you got the plan, make it happen. And then the other voice is saying, like, hold on a sec, like I'll give you an example. A company I really respect in our sector, the CEO just made this long LinkedIn post on all the subscriptions he was cutting. He's a similar sized company and he raised a couple $1,000,000, and they are making a plan for 36 months not to raise another dime and to make sure that they weather the storm. And so they're buttoning down the hatches and throwing a bunch of unnecessary supplies overboard right now. And I'm going, whoa, is that a good reaction? Is that an overreaction? And I don't know how to do this. So what's moving on my mind is that issue.
So I'm going to repeat back what I think your question was. Your question that you're dealing with right now is, how do you process hitting every single one of your goals, making everything that's great, you're still growing quickly, and balancing the fact that you're raising money in an economy or in a market where everyone's telling you the sky is falling, there's a crypto winter, there's an investment winter, and you're having to decide, what are my next steps? Some companies are battening down the hatches, but you want to run with the wind. You feel like the wind's at your back and you want to raise sales and you want to just go. Is that about right?
Yeah, because all of my internal inputs are the same. Lead growth is the same. Web traffic is continuing to rise up. We have stronger and stronger pipeline velocity. There is nothing showing me on my dashboards that things are a threat or wrong, and there's a risk right now to stretching out and continuing with the plan we built in Q2. I'm getting no feedback from our customers or partners. We're seeing no churn, no contraction. And so I had a hypothesis that we would be recession resistant, and perhaps recessionary things take a while to filter down to the level of a SaaS subscription in cybersecurity for a company. Maybe that's the case, but I'm a little befuddled as to how to work that all in. Do I ignore it? Do I react to it? And that's where we are in our journey, because I have a couple of tactical things in front of me. I have a strategic investor who wants to put money in to get us just to the next gas station, right? Like a 2 million ARR. Put enough money in, get you to that gas station, which delays our fundraising. Well, will it delay our fundraising so that we end up needing capital in the middle of the harshest part of the winter a year from now? Or do we go ahead and raise and build out the plan through and burn hard through the winter?
Oh, we're losing your audio. Yep.
Well, yeah. So those are the things on my mind.
Well, that's interesting, because my question is also the same way. We've got portfolio companies that we're raising money and we're going to deploy capital into, and the valuation of those companies is what's on my mind, because just like you said, they're performing well, they're checking all the boxes, and yet the market is saying that valuations should go down. And so I'm like, but my mission, the mechanisms inside of the fund, they're still presenting all the things. So it's almost like I don't have that full equation of how valuation should be set. And it seems to me that it's about three different things. The first one is all the KPIs you mentioned. How's the company doing? Second thing is, what is the market saying those kinds of companies are worth? Because you kind of have to go with the market that's going up and down, or maybe you don't. And then the third thing is, what's in the best interest of my LPs and what kind of deal can I get? Because it seems to me that there is a conflict of interest and misalignment from a venture capitalist who is trying to get the highest returns possible for their LPs, and the entrepreneur who is trying to build an amazing company and also do all the things, right? But it's like, if you push too hard as a venture capitalist to take and dilute folks so much that they're no longer interested in running their companies, then you've lost the game. And also, you have to turn around and make sure that the LPs, your limited partners who invest in your fund, know that you're still trying to find good deals for them. And I hate the idea that, you've come up with a good idea, a good compromise when everyone's disappointed. I feel like that's a lie. I feel like we don't have to play that game. And so, maybe that's the thing that we talk about today is we talk about this conversation of valuations in startup land, particularly around a series A or a bridge, which is, and I don't know we have answers, but I think it's valuable to have these kinds of conversations. Does that sound like a good use of our time today?
Yeah, absolutely. I'm happy to talk about evaluations and what we're seeing in the conversations we're having from our perspective.
Cool.
Absolutely.
Yeah. All right. Well, let's do that, and I love my voice, so I'll start. Um, Listen, Zach. Here's the thing. I want the entrepreneur to win. I come from the entrepreneurs, 22 years in the game. I know how hard it is to do the thing. And I know how depressing it can be when you sell your company and it's not quite the valuation that you thought. You thought you built a thing and you were like, I'm going to win the game and it's FU money and I'll never have to work again. Like, nah, bro, sorry. You got the valuation wrong. There's no way that's going to work. Here's actually the money that's on the table. And you're like, that's less than a third of what I wanted. Right. And yes, you feel like you win the game, but then it's exhausting to get back into the game. So for a lot of entrepreneurs, their companies that they're working on are going to be their one shot. Meanwhile, at the VC side of the house, I'm going to be looking at hundreds of deals and I'll be making tens of investments on these particular funds. And I don't have that same kind of all or nothing mentality where this is my one shot at the thing. So it sets up a conflict of interest for me personally, where I want the entrepreneur to have the most success possible because I want this to be a thing that's worthy and that they're proud of and that they left feeling good in the game. And also I need to hit particular numbers on particular time frames because that's what I told the people who gave me money. What I think the right answer is to come and have real conversations with the entrepreneur. What are you trying to get done? How much money do you need at what stage? And what valuation gets you that money and also keeps you interested? And if it's a valuation that's higher than market, but not so much higher that I can't justify it, then I want to go with that higher valuation for that entrepreneur so that we build a healthy company that has the gas and the enthusiasm to get to Series B. Um, that to me is the right answer where I can go back and forth on that. What's your feedback? Why don't you use your stone and throw it at this bird?
Yeah. I think what you're talking about is the difference between founder friendly VCs and investment VCs, right? So investment VC is how do I get the most equity out of a company at the lowest valuation possible? Because if they hit a home run, base hit, double, triple, I'll still be able to make a return on it. I
Right.
de-risk my capital because the threshold and the carry is lower, right? Investment VC. Founder VC, which investment VC has this middle to long term view. Founder friendly firms are long term. They are in it for the long ride. They see the multiple rounds. They say, what do we need to make sure that the founder and the entrepreneur is properly supported through each stage so that they can continue this journey on?
Hmm.
And they recognize where they're at to set them up for the next domino, right? And so, um, you know, any VC firm in the space right now will say they're founder friendly, but
Mm-hmm.
that's not how the terms work, right? So they will always show up and they'll say, well, hold on, in our experience, we've seen it's most helpful to you if we're the single source of capital. In our experience, we've seen that it's better if we really have like a controlling interest in the company at 40% equity on your Series A. And because that really gets us, engaged, and that allows us to work together, and we'll bring this back office. And that's not founder friendly. That is investment VC work because they're actually serving the LP, not the founder,
Mm-hmm.
when they make that investment. So I think that's what you're hinting at or
Yeah.
getting into.
Well, and to be fair, it can be different, right? And so maybe it is founder friendly to say we're going to handle all your back office, we're going to toss all this stuff at it, and we're going to take 40%. And maybe that is founder friendly for some founders, but the idea that that amount of equity leaves at Series A is shocking. Like, you better understand what's going on, and you better know that you're going to do it. And you really should understand that, you know, if your back office is a thing to go, then your front office might be the next thing. And your C-suite might be the very next thing, because you're getting into private equity territory at this point, where the next round of funding, if it comes from the same source, now they're going to own the majority by the time you're done with the Series A, or by the time you're midway through to your Series B. And so I just think you got to understand that, right? And to me, that is not necessarily founder friendly, but I can understand how a VC would use that, or a private equity firm would use that, if what they believe is they need a quick turnaround, and they want to sell the thing in 3 years, and they want to put all the resources in place. And the entrepreneur's like, yes, I also want that. I'm not trying to build a unicorn here. I'm trying to, get a home run, but not necessarily win the whole game. What does that hit on you?
Yeah, so I think it's very interesting. I know it's somewhat gossip and a rumor, but a competitor of ours who sold here recently because they started stalling on their growth, right? So a private equity group comes in, gives them a few $1,000,000, and they keep going, and they hit 3 million ARR, and then they're having trouble getting to 4 to 5, and they don't see a path out. They don't
Right.
see a trajectory to a new green space. And so what they ended up doing is they sold, but like the press releases were all about like this was the best thing because we helped a founder really fulfill their dream and be able to move forward and et cetera, et cetera. And so they couched it as like you can tell behind the scenes the private equity firm pushed for it because they're like, sell now, we need 2x on our money in 3 years, it's the best we're going to do, everybody's going to be happy, this is founder friendly, this is as friendly as we can get to a founder because you're going to have to reinvent yourself.
Mm-hmm.
However, right, like the research, I'll say that lightly, I don't know, I've just heard people who say the research, I don't actually know the research. The research suggests that people who are wildly successful are the ones that start over the most. So the people who climb up 2/3 of the way of the mountain, realize the pass is blocked, go back down the mountain and start again and go up a different path.
Yeah.
Like those are the people who are wildly successful. It's the ones that start their third company at the age of 40, even though they have all these degrees, they have all this, they say it's worth starting over, it's worth pushing again. And so to me, an interpretation of a founder friendly investment firm would have said, listen, you hit a roadblock here, you're in the mid threes, you don't see a way to green space, why don't we bring this back in and try to reinvent and push to a new space? What could we be? And then that's your breakout, right? Because you've learned all the lessons and you have a team, you have the resources, you have the institutional and competitive landscape knowledge, and you can scale up even faster.
Yeah.
To me, that's a founder friendly relationship where you can call anything founder friendly if like the founder walks away with a few $1,000,000. You're like, well, yeah, we're founder friendly VC firm.
Yeah, we'll get you an exit.
Firm. Yeah. So, and I think that's one of the things that's kind of in my mind is like, yeah, you can call it what you want, but I think true founder friendly is banking on the founder over the idea through the entire life cycle and saying like, whatever your idea is now, go for it. But if things push comes to shove, we're backing you, Mr. Founder, and a new set of ideas to get us to where we need to go.
Yeah, I would. I like what you said, and also I know a lot of great entrepreneurs who outkick their coverage and don't change and grow as fast as the company needs them. So I like what you said, and I want to pivot and play with it a little bit. I think founder friendly is we've got a partnership with you, founding team, and also we need to be aligned that what we're trying to do is build a company that has an exquisitely beautiful share value, because we all need to be aligned on our exit is going to be based off of what that company's valuation is in the market. And maybe if you're wrong and the founder begins to flounder, that it's up to the VC to have good hard conversations and say, hey, look, what does it look like to put somebody else in charge while you retain your equity and you retain a role? What about this? So where I'm going with this is I actually have seen this hundreds of times where you've got a great 0 to 1 entrepreneur. I created something from 0. I got it to 1 million ARR. We've got all the things. And now it's like, cool, now it's time to grow, systematize HR, all the things. And then the entrepreneur against the founder. So I would say that a entrepreneur, founder friendly VC firms is upfront with what all this looks like, is transparent with the levers that need to be pulled, that are on the side of the founder as a shareholder and as a visionary, and guides that founder into saying, hey, look, operational functioning of the company has nothing to do with how beautiful your vision is and the equity that you have. We're building this together. And maybe the people who grab the 40% have had negative experiences where they try to have conversations with those founders and it hasn't gone well. And the only way they can guarantee the health of the company is if they own the majority of it. I think that there's a better solution. I think that solution is called emotional intelligence, good conversations, better due diligence, not on the paperwork. I always think it's hilarious when like, send me all the information on your startup. Cool. It's in Cran, bro. We're like so early. Here are my financials, and this is a butterfly, and this is Cookie Monster. He's my favorite. He's overindulgent, but he's got a positive attitude, right? And it's like, great, that's your due diligence. No, I want due diligence on the coachability and the ability to learn and the founding team. To me, that's what you need to bet on at the early stages: is what's the market doing and how adaptable is the founding team. And that's where due diligence should be. And I think that if you can maybe identify whether you're in dangerous waters with a venture capital entrepreneur relationship, whether it's founder friendly, is how are they running their due diligence? Are they completely ignoring the mental health and the culture of your company, and all they're doing is asking about the KPIs that fit in a spreadsheet? Turns out business isn't about what works in the spreadsheet. Business is actually all about the culture and the energy and what's going on with those people and their abilities to adapt to markets, their abilities to adapt to trauma. That's what that shit's all about. Bam! We should be recording this shit. Oh, dude, we are.
I'm gonna grab where you just left off there, because I agree mostly with what you're talking about, and I think there's more level of nuance. But when it comes to how to evaluate a founder, I'll tell you how I wish I was evaluated. I wish that people saw my metrics and all the data. I wish that I could show them primary source data. I wish that I could show them website traffic, HubSpot lead conversions, demo to ratio. I wish I could show them all that. And then I wish they had the curiosity to ask me about my behaviors and my decisions at each of the inflection points, so that they could see my track record and how I process, how I think, and how I behave, and how I work out issues, and how that translates into data. So then when I show them my projections, they can interpret and have an insight into what will happen when those projections start to falter one way or the other, what will be my anticipated action. And what frustrates me is it's very rare that a VC will ask me about my behaviors and decisions and how I felt, what was going on in my head when I encountered this issue in this. So right now, VCs are, I'll give you an example, right? There was a time when we were like burning extra cash, and like this is in late 2020. Cash was going like this, and sales actually dropped off. I experienced like a couple of churn because we didn't really have a good subscription model. And rather than anybody ask me about that, they just go, what happened there? And then I'll say, well, we this, and then we course corrected and we brought on a couple of people, etc. And they go, okay, no, I want you to say, like, tell me what was going on in your mind. Who did you reach out to when you realized that that was an issue? How did you figure out that that was an issue? Where did you, at what point in time did you make the pivot and,
Yeah.
decide to let go of some teammates and to bring on other folks to make this thing work through that swing? No one has ever asked me that. No VC has. And we've talked about various points of due diligence before with your fund. That would be what I would want to do. I would want to, here's all the data, but then I want to go into it and find all the bumps in the road.
Right.
And then ask them, what was going on in your mind, so that I have a model. So when we look at future issues, how will this person likely respond to a challenge?
I wonder if that level of, so what I heard you say is, I'm more than just my numbers. I'm a human. I'm a person. I want to be seen. Right. And I wonder if at the early stage investment, when you're a VC writing checks for 200K to $1 million, and maybe you've got to write a whole bunch of checks, and so you're going to be just churning through companies. I wonder if your experience raising the Series A is going to be different than your experience in the seed and the bridge. I wonder if you're going to get that kind of question, because haven't you experienced different kinds of due diligence now that you're playing with bigger money and now that you're playing with different kinds of stage?
Yeah, absolutely. There's one investor in our bridge here who showed up on a call, he himself being a founder,
Mm,
right? And he had his exit. So
mhm.
he's doing one of those things where he's turning and putting the rope down behind him to pull other people up. And which is what I wish to be one day. Like that's part of my vision of myself. And he gets on this call and he says, "Hey, I want you to know I already intend to invest. I already have conviction around this. My people I respect, know, and like are already in. So I intend to invest. My investment is usually between this amount and this amount.
Mm.
I still kind of have to figure some of that out, but my conviction's here. So if you wouldn't mind, I would love to talk about the thing you're not allowed to talk about with investors.
Oh, sweet.
What's the thing going on in your mind that you always have to like dodge around and hope that nobody asks? Because I'm here for it. I want to help you really address that so that when we go out to raise more money, you're going to feel much more comfortable about that,
Well, that's a
right?
special person right there. That is not a typical conversation.
Yeah, but that's a founder
Yeah.
to a founder, realizing that's the kind of that is
Huh.
pure founder friendly, right?
So you just struck something. There's some data out there that I absolutely love, and it's the more MBAs you have working in a fund, the more likely it is to fail. Like there's statistical data backing up. The more I went and got my MBA, and I'm not throwing shade at MBAs. I'm just saying statistics, baby. And the idea that there is another group, which is funds ran by former founders. I don't have the data on that. I'm curious if they make better picks that turn out. I wonder if the track record, I'd love to see businessy MBA, no track record ever founding a company versus founders who started funds and invest in other founders. And just to see, I wonder if there's data. I might look that up and put that out there. Do you have any thoughts on that?
I mean, I think you'd probably start with the founders fund, right? That's the famous one out there, and they're the ones that change the terms in which you approach founders, and they're credited with taking out the adversarial relationship that was emerging between VCs and founders, especially in Silicon Valley in the mid 2000s. And so I think their track record is probably real strong and speaks for itself. Um, and then I think there's a handful of others that the Andreessen Horowitz, which was founded by a founder, right?
Hmm.
Sequoia is famous for really digging in and helping the founder get to where they need to get to, showing up as a coach, showing up as a guidance counselor, right? Those type of things, saying like, we're here to remove roadblocks for your vision. Sequoia goes out of the way not to invest on their vision of what they think your company will be, but they work really hard to make sure the founder's vision is instantiated, and they remove roadblocks for the founder's vision. That's a Sequoia mantra, as it were. So I think there are some of those folks out there that you could probably sink your teeth into. But since there's so many funds and so many PE folks, I think you're probably harder pressed to find the data on founder friendly folks versus because LPs love a good MBA. They love a good Ivy League story, right? They love somebody who hit it big on their first fund and is always chasing that dragon.
But the reason they love it is they believe it de-risks it, because it puts it down into a spreadsheet, right? And so what an MBA is really, really good at, what a previously successful fund manager is really, really good at, is building the deck, building the spreadsheets, and laying out the business case. And a lot of what you and I do have little to do with a fancy deck, a sexy spreadsheet, and a really clear and concise, pithy business case. What it is really messy, where we are in a full contact sport. Our gut begins to feel things. And I learned from the brain camp I did last week in Colorado that gut feeling you have is actually you processing stuff. It's actually electrical stuff. That the gut feeling is real. It is not a so when we're leading and we're acting following that gut feeling, that's a part of our processing that is hard to put into language. And so we often just don't put it into language. We often just go and do. And by the way, that can cause its own problems, but it's usually correct. It's usually that unspoken thing that we don't know how to put into words, but we get it just hands down and we go do. And I think that if you're trying to pitch something and you have that gut feeling and you can't put it into words, if there's somebody who's not on the other side of the table who's like, oh dude, I've been there, I get that gut feeling, I understand exactly what you're talking about, let me help you pull the words out and we'll work together to get there, rather than now you're gone. And I feel like that's what you get with founder friendly funds. You get that permission to be less than perfect, less than shiny, and have real conversations like you did with that gentleman who said, no, I'm going to put money in. Let's take that off the table. I've seen your numbers. It's great. Everything's good. You've checked the boxes. Now tell me the thing you can't tell other people. Oh man, what a special gift that is. By the way, I want to like reach, hey, Founders Fund. But while I know you guys are subscribed. It's truly cool. I know you're one of our 12 subscribers. Just everybody involved with Founders Fund. I would love to just talk to these folks who set up these founder friendly funds and be like, dude, what is this all about? How's it working? Is this hypothesis real? Because at the end of the day, I have a fiduciary responsibility to provide returns to my LPs. If somebody gives me money, I feel a great deal of responsibility to make sure I give that money back times whatever I told them I was going to give it back to. And so there's this real thing where doing good in the world also has to be doing well. I want to have a positive impact with these entrepreneurs, and I want to make dump trucks full of money so I can go do it again and again and again. And if the business case is founder friendly funds produce better returns and better results for limited partners, that's the thing I need to know so I can make sure I have it in my thesis. I have it in my manifesto. I got to do all that. So, dang. This is good. You should sit in like space coffee shops all the time.
Yeah, I think.
Did we kill this bird?
Oh, I think the bird's dead. Absolutely.
Okay. Yeah. So one of the other things I would love for you to do, you're really up to speed on a lot of this stuff, and you kind of already touched on it. But what's the state of the VC world as far as you're concerned right now?
As far as I'm concerned right now, I think VCs don't know where they are because
Mm,
they sit on excess capital right now that they promised LPs they would put to its highest and best use with the most potential outcome based upon whatever agreement they had, right?
yeah.
What type of carry, what all this, etc. Okay, that's cool. Well, these LPs actually have assets under, call it compression right now. And so the funds themselves usually haven't done a capital call on the LPs in total, especially if they're a fund that's, over 30 million.
Right.
And so you have that type of threat in the back of the VC's mind. And then you have this push to say, like, if I'm going to invest, I have to have a great deal right now.
Mm-hmm.
Not because there's a lack of supply. Supply on deal flow has stayed the same and it's probably dropped off a bit, but they are trying to make sure they get their marks because every fund has a 5 to 8 year horizon right now. Most funds do. So they're saying, all right, 8 years from now, we are bullish that the market will be back. But how do we get the capital out in such a way that these things don't go out of business in the next 2 to 3 years? And what that's leading them to is, I think, exacerbating the 80-20 issue, where 20% of the founders are going to get 80% of the capital interest. And so what actually is surprising me a lot is how much VCs ask me to do their cross-pollination, because I'm the one talking to all the VCs. So I can't tell you how many times VCs like, well, what are you hearing in the market? You're talking to other VCs. Tell me what's going on out there.
Well, dude, that's what I'm doing. I'm too busy looking at deal flow to know what everyone else is doing. You're the one talking to VCs.
Yeah. And so
Yeah.
they go, yeah, tell me what's going on over there.
Who else is scared? Who else is terrified? Anybody? Is it just me?
Yeah. And so what I think is interesting is, depending on who you listen to, I'm a believer that what we have is a supply side recession. We don't, and the only way we know how to fight recession is through demand. So, which is Fed interest rate work, right? And so what we have is a dearth of supplies. We interrupted it with COVID and we still have not gotten back up, whether it's housing or, supply chains for manufacturing, et cetera, et cetera. We have issues with our food supply. We have issues with our gas and oil supply. I believe we're in a supply recession.
Interesting.
And the only tool we have is a demand recession. We can push demand down for all these supplies by raising interest rates. Well, that's not really what you would want to do. What you would want to do, if you were God and could wave a magic wand, but there's not, is you would take capital that's on the sidelines and you would put it towards technology, which is deflationary, right? Technology takes inflation out of the economy. You put it towards technology companies and you put it towards supply vendor tech work in particular. And you would focus in on supply chain. You would talk about food and food access. You talk about oil and oil access. You talk about, energy alternatives. You would talk about all those things coming into play, that if we can keep demand up and we can just get supply up, then we'll find a new equilibrium faster. So one of the things I think is interesting from my perspective is, like, I don't think VCs see themselves as the hero in this economy. They see themselves as the takers. And so they're just anxiously waiting to see if the Fed raises rates. They're anxiously seeing if the market adjusts to see what the market trades at, what multiple. And I'm sitting there like, literally, you guys, if there was some sort of consortium, some sort of OPEC for VCs, you all could agree to move this economy out of a recession. You could do that, but that would require everybody working in concert with each other. But that's not how VCs are. They are not leaders. They are followers.
Ouch.
Sorry. I don't know if that made sense. It's more of a tirade.
No. Okay.
Guess, yeah.
So I'll summarize your verbal diarrhea. Hey, rather than handling the supply issues, so hey guys, here's the plan. Let's crush demand by making people unable to do anything because of high interest rates, and then supply and demand are equal. And you're like, no, bro. What about this? What if demand is like way up here and we increase supply? Whoa! And how do we do that? You spend money, venture capital world. Oh, can't the private equities do it? Nah, private equity moves around the decks of the ships and the things and the chairs, and that's what private equity does. Private equity plays up here. Venture capital produces new value in the world. Private equity moves capital, moves value in the world. So, okay, VCs, dudes, go to like a really cool conference. Everyone get together and look at each other and go, "You want to spend money? Okay, let's spend money. What should we spend money on? Well, let's spend money on things that increase supply, that solves the problems that are restricting supply, and in the technology necessary so that we can deflate this inflation." Is that right?
And yes. By the way, I do think there's a counterpart to that. If the VCs as a whole were to move in concert, capital allocators began allocating capital towards technology that actually changed the supply equations. I think you still have to have a policy set, especially at the federal level, which would reduce tariffs on all supply trade. Right now, we have a tremendous amount of tariffs and tax, and you would have to open up immigration so that we can get the worker and the workforce needed to be able to work, especially in hospitality and retail, which are right now struggling. And you would need to, so you would actually have to have an immigration overhaul and a tariff taxation overhaul to really change supply, because we've restricted supply based on our political policies. And so I'm not sure that will happen.
Oh, no,
And I
it
think,
won't. Yeah, you're right.
and what will happen is the VCs have all the cover they need, which is like, well, we're willing to invest in, let's say, rare earth minerals to be able to build out a supply of chips that we can put into our new Ohio, Silicon Valley of Ohio, whatever that
rolls off the tongue.
Called.
Yeah.
Yeah. It's in Dayton or Columbus, right? Ohio. They're building the largest the chip factory in the world. Yeah. But we need rare earth minerals to get there. And, you got deposits in various countries that have various forms of aggression with. And we're trying to figure out how to leverage that and still tax it at the borders before it comes in. And so you have all these issues where it's like, let's open up so that the deflationary stuff, which is technology, right? The Fed just said that our inflation's entrenched. It went from transitory, which is like, it'll go back to normal. Gas prices will come back down. The Fed just said, hey, taxes or gas prices are probably always going to hold their mark at $4 or more from now on. The money is staying in the system. It's entrenched. And so so VCs can look at that and say, like, until the world becomes friendly to our terms so that we can go invest in rare earth technologies, rare earth mineral technologies, or we can go invest in alternative energy technologies, etc. Until that becomes friendly to us, it's too much of a risk. So VCs could save the world right now, but they don't have to, because they have somebody to blame in the federal government and those policies, preventing them from saving the world.
Yeah,
I think that's what's happening.
That's absolutely shitty.
I'm sorry, I didn't mean to. I think this is what we're up against.
Well, I asked the damn question, didn't I? What's the saying? Don't ask the question you don't want to hear the answer to. I was like, what's the state? And I was like, oh, there's some people are scared, but at the end of the day, everything's fine. And you're like, we're going to be stuck here forever unless we get immigration and policy.
Hey, I think so. Technology will continue to grow. So, like, again, technology is inflation. I just think it's going to take 2 to 3 years to pull the capital out of the system, do quantitative tightening, and allow technology
Mhm.
to catch up. So if everybody stops what they're doing and just lets the thing play out, it's a 2-year recession, right?
All right.
So I think the VCs are looking at that and they're taking their marks appropriately. And the markets are usually already 1 to 2 years ahead on their pricing, right? And then they lag on their uh, I just lost the term for it, but uh, today's pricing is not accurate. That's not how their pricing is. And so
So,
when we talk about share prices in the future, right now we're trading at 8 to 10, and that's tough for a company like us, right? Because the most that a Series A is ever going to do, ever, is going to be 2x that. So I have to find the right firm who believes in us to give us a 16x mark right now, right?
well, and
And
that to
that
me sounds like somebody who is betting on your Series B. This sounds like the people you want in your Series A are people who are willing to do the 2x on their A money, because they know by the time you get to the B money, they're going to have an opportunity to do something pretty magical with that.
Yeah, I think you're right, but the B money has to be projected at 30 to 36 months. So the B money has to come on the other side of whenever they think the
Yep.
correction will be corrected. And so,
Well, and that takes a special kind of VC to be able to play that game. It's like,
but as a founder, I now have to raise more money because they want me to have a 3-year plan and not an 18-month plan before my Series B. So I have to raise more money at a lower valuation, which hits me harder with dilution, right? So that's what we're looking at internally at Hook, is like I'm being told I need to raise 6 to 8 million, right, on a valuation that's pre-money, possibly 12, 13, 14,
hmm,
right? By the time all my notes and everything convert, I'm going to be at 50, 55% dilution. And
yeah.
that's what it takes to get through this on the other side.
So if we go back to your question that you led with, and you're trying to process all this, it doesn't sound like there's it just sounds like we're in a season where, in order to get the funding that you need to make the company do what you want it to do, dilution is inevitable. The lowest risk is the founder's dilution, is what I'm hearing. And
Yeah.
so then, if that's inevitable, we have to change how we do business and compensate the entrepreneur. So I'm thinking there's got to be other incentive programs inside of the company that allows the entrepreneur to either get some of that equity back in later stages, put cash in pocket along the way. If we're going to say, look, for the next 2 to 5 years, next 2 to 4 years, entrepreneurs are getting diluted, what do we do to keep them in the game? I think that's the next dialogue that we have to have, because
That's right.
Get that war chest, man. Build the company, and if you need 6 million and it's going to dilute you in a particular way, just go get the 6 million and let's figure it out. And I think that's the conversation that we should be having next week. not now, because we. But yeah, what do you think? Should we tackle that next week in our next call?
We can absolutely tackle it.
Founder
I
compensation.
Founder compensation in the face of dilution.
Yeah. I feel like there's a joke in there that if I just worked hard enough, but honestly, you kind of depressed me a little bit. Actually, you did, and then you didn't, because when the status quo changes, when there's something happening and there's some kind of traumatic experience, that breaks up a lot of the old norms. And so I'm going to choose to believe that this is going to open things up. This is going to open up different sources of funding. This is going to open up different ways of compensating entrepreneurs for building companies and wealth. This is going to open up a lot of stuff. And the people who are creative enough and enthusiastic enough to jump into what does this disruption mean for our capital allocation industry, those are going to be the people who are going to be the leaders, the next Andreessen Horowitz, the next Founders Fund. These are the times where those firms are being built.
Yeah, I think that hypothesis is right. And the exciting thing is that we might be able to knock off like the FANGs, right? Like just because they're still have these startup cultures, the Facebook, Amazons, or I guess it's Maine, right? The Metas, the Apples, the Amazons, the Netflix, right? The and Google, like that other companies will merge right now. And so those companies were quote disruptive, but now they're not. Like now they're stale.
Yeah.
Right.
Now they are the status quo. They're the IBM.
Yeah.
Yeah.
Yeah. So now they're the IBM. Now the target's on their back. And when we have a reset like this, and we have the ability to stop, reframe, and say, what if there's a better way to curate and search data online other than Google? Somebody might figure that out. Somebody might come along and say like, oh, here we go. And so now that's going to be the fun thing. So these resets are wild because you can't predict what will come out of them.
I'm noticing a trend that you just hit, which is more and more of these companies that I'm looking at for potential investors. I mean, potentially investing into are companies that said, here's a suite of dinosaur technology problems that all do a particular task inside of a particular vertical that none of them cooperate or communicate. And I've created technology that removes 12 of your other products and seamlessly integrates and gives you a control panel that you can interact with the business system that these software products and these technologies interact with. And what I'm asking people to do now when they're bringing me, it's like, no, don't tell me what you do. That's kind of hard for me to grasp sometimes. Tell me what you're replacing inside of the technology stack. And I've got 2 portfolio companies that are like, boom, 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 boom. These are all the ones we're getting rid of. And here's the customers who love us. And to me, that's the seed of planting like, oh, I'm going to disrupt long-term healthcare forever. And we're going to become the next thing, or I'm disrupting knowledge management and how we, share information and search information. Like one of the guys I'm looking at is a disruption against Wikipedia. Like, holy crap. Now, if I remember, Wikipedia doesn't make a lot of money. I don't know. I've never looked into it, but no, that's pretty. Yeah, you made me sad and now I'm glad. And then I got really happy. So it's a fun time to be alive. Yeah, it's a fun time to be alive, right? When you're in the storm, there's some opportunities. The thing is, don't fight it. Go find the easier thing. Don't sail through the storm. Sail with the wind.
That's right. And keep your eyes open.
Yeah,
that's right.
Hey, and thanks for joining us for the TSOB podcast. Find us on LinkedIn and give us your hot take. The whole reason we're doing this is to get access to better conversations that help us up our game. And if you have something you want to share, we want to hear about it. Find us on the TSOB LinkedIn group and jump in with 2 feet. We can't wait to chat.